And welcome to the all-new That Business Show 2.0 with your host, Jamie Maloney, where business becomes show business. Today, we're going to be talking about the precious metals market. I've got Peter Hugg, Director of Global Trade with Kitco, with me on the program today. So, Peter, welcome to the program today.
Jamie, a pleasure to be here.
So, first off, tell me about your background as a trader, as an investor in precious metals.
My background?
Yes.
Yeah, I'm one of the oldest in the business probably now. There's a couple of guys that are still around. I started in the business in 1973. I cut my teeth on the foreign exchange business, worked for the largest global retail foreign exchange dealer company called Pereira. They did primarily foreign exchange, a little bit of metals business. Then in the mid-'70s, joined the Canadian trust company called Guardian Trust. We developed a precious metals program, and we grew to be Canada's second largest precious metals dealer behind the Bank of Nova Scotia throughout most of the 80s and early 90s. Then in the early 90s, I took a sabbatical from the metals market. Was the CEO of a company in Canada that introduced microchip identification technology for pets. And got back in the metals business in the early 2000s and joined Kitco in 2010. They had grown from staff of 8 people to well over 200. And the owner of the company asked me to come in and run their precious metals division.
Now, we've been hearing a lot about gold in the news over the last couple of years, a lot of uncertainty in the marketplace, a lot of people fleeing traditional investments and going into, gold and precious metals. Is gold still a viable investment option for people?
It is. It really depends on how you ask the question, Jamie, and really what the psychology is, the motivation on why you want to buy gold. Gold's not the catch-all, end-all. Gold's a good investment at times, and it's a terrible investment at times. There are cycles in all markets. Commodity markets are certainly used to cycles that run anywhere from 5 to 8 years, some as long as 10-year cycles. And, the gold cycle that started in 2002 and culminated in the high of the price of gold at 1925 in 2011 was almost a 10-year cycle. We've been in somewhat of a bear cycle since the high of 2011. We're about almost 7 years into that cycle. There are times when you want to be more aggressive on your gold positioning and times you want to be less aggressive.
How does that compare to silver, for instance? Is silver a more viable metal versus gold today?
No, I think silver, they call silver gold's little sister, and I think silver moves with gold or tends to move in the same direction as gold. It tends to move, when the markets move higher in percentage terms, silver tends to outperform gold on the upside, also tends to outperform gold on the downside when the markets reverse. Gold has a sort of a unique place in the psychology, in the minds of investors, as a safe haven investment, whereas silver, although it follows along the coattails with gold, also has another component to its value, and that's the industrial use. You could have a situation where there's no major political or economic issues to drive the price of gold higher, but if you have a significant economic rebound and the supply-demand equation for silver from an industrial perspective shifts towards the deficit, which it may happen with silver's use in solar power and things like that, you could actually have silver outperform gold on a market that is less aggressive than we had between 2008 and 2011.
Now, we've seen the stock market going to all-time highs over the last year, but you see so many scare commercials out there about inflation and the national debt, and you need to be into metals, precious metals. To what degree is that true? Should we still be scared of traditional stock and bond investing?
Well, I don't think stocks are necessarily a good investment or necessarily a bad investment. It all comes down to timing. The stock market at one point today was down 240 points on the Dow. The tech sector has been getting creamed for the past 3 days, but it's had a massive rally for the past 6 months. So again, it comes down to timing, and when you're looking at the equity markets, you have to you look at the fundamentals on the equity markets, you look at the earnings, you look at where interest rate policies are going to go, and then you make a decision whether the earnings make sense from a valuation perspective, and that then gives you some type of guidance as to whether or not you think the markets are going to go higher or lower. But if you're looking at gold in context with that, it really, again, having been in the business for almost 50 years now, I've had the questions that I get asked today are the same questions I got asked back in the 70s when gold first ran up to $850 and silver touched $50 for the first time. A client asks me, should I buy gold? And my question, I usually don't answer the question unless I get an answer to the following question, and that is, what's your motivation? And there's a couple of psychological groups that invest in precious metals. One is sort of the end of worlders. They think the world is going to collapse financially. They think the government is going to ban the ownership of precious metals. And for that group, the price becomes irrelevant. They just buy it because they believe the price is going to go to $5,000 or $10,000 an ounce, and they're going to need it as a mode of basically financial transaction capability when Armageddon hits. So, that mindset, it's not really relevant whether you're buying gold at $1,200 or $1,500 or $900, because your belief is the system is going to collapse and gold is going to go astronomically higher, and you're going to need gold to barter.
So what drives the price of gold then? Is it market uncertainty and fear? Because the supply of gold is pretty much fixed. There's not a lot of gold that's, it's still out there. I mean, people are mining it, and but it's few and far between versus olden days. So what drives the price? And it's like you said earlier, it's not used in a lot of different applications. So what drives it?
Well, basically, commodities are priced in U.S. dollars. So if you get a scenario where the U.S. dollar weakens, then commodities generally lift as a group. Gold is looked at and continues to be looked at as a safe haven. So that takes me to the second class of investor that basically has been told, again, ever since the 70s, that you should hold a percentage of your portfolio in gold in case we get a 2008 type of scenario. Or we get a geopolitical type of issue that could develop with North Korea, Syria, Iran, and that basically is the position that would protect the balance of your portfolio. Now, that statement in and of itself is only half true. So what these analysts that keep parroting that you need 5 or 10 or 15% of your portfolio in gold, and I use gold in a generic sense here, whether it's physical gold or ETFs or gold mining shares or mutual funds, is your portfolio needs to be calibrated, rebalanced on a regular basis. My recommendation there would be at least every. Now, if you're holding 10% of your portfolio in gold, the balance of your portfolio, you need to make adjustments to your portfolio. To give you an example, had you bought gold in 2008 at $650 an ounce, 2011 gold was $925 an ounce. If the concept of your holding gold was to protect the balance of your portfolio, and you wanted to hold 10% of your of your portfolio in gold, I would almost guarantee you when gold hit $1,900 that your 10% was probably now more reflective of about 18% or maybe 20% of your portfolio. In that context, you need to sell 10% of gold. Vice versa, had you gotten in at 1,900 in 2011 and then in 2015 gold was at 1,050, portfolio holding in gold was not 10%, it was more than likely only 4% of your portfolio. In that context, you need to buy 6%. That gives you your insurance position of 10% at all times, but it tends to get you out of the gold market or to reduce your gold exposure as the price goes higher and increase your gold exposure as the price goes lower. Because if it's an insurance position, you should be thrilled if it's not doing much. Even if gold comes down 10%, you're only going to be losing 1% of your total portfolio value. The other 90% of your portfolio, if gold is coming down 10%, should be performing extremely well. So it'll more than make up for it.
Very cool, very cool. So how does one actually go about buying gold or silver, and where do they actually hold the gold or silver? Can they actually have it in physical possession? How does this work?
Again, it really depends on your psychology. So if you're in the first group where you are really concerned about potentially U.S. government interference with your investments, or you're concerned about the collapse of the financial system, you tend to distrust paper gold. By that I mean ETFs, the futures. Futures, you want to buy physical gold. Now, if you want to buy physical gold, and if you're in that first group, the irony is they buy it from an American dealer. And the problem with buying it from an American dealer is if the government bans gold ownership, the first place they'll look is the American dealer and get their client records. So if you are going to go that route and you're worried about Armageddon, you need to buy gold physically, but you need to do it from a geographical diversification and hold it outside of the U.S.
So how do you know you're getting a fair price and when you're buying gold in then? Is it just what the market value is, or how does that work?
Yes, the gold price is posted on numerous sites all around the world. It comes out twice fixed in London, so you know where the spot price of gold is. You look at the units you want to buy, you see what the premium is to the gold price, and then there's a myriad of dealers that you can compare the price to and shop. So you can negotiate your price. It helps if you have some volume, but if you don't, there are numerous places you can go and check the gold price to see where you can get the best deal.
Now, Kitco, how does Kitco factor into all this? Tell me a little bit about their position.
Well, Kitco basically has a three-pronged approach to its business. One, obviously, we have Kitco.com, which is our major news site. We have about 1 million unique hits a day, and we provide market commentaries, both bullish and negative, on the metals, mining stocks, and a variety of other precious metals-related investments. So clients can come in and get educated, and they can also read various analytical reports and make their own decisions whether they want to buy or sell. Then we have a division that sells physical precious metals, which we can deliver directly to a client's home, or we can hold them in segregated safekeeping in the client's name in either the U.S., Canada, Europe, or Hong Kong. And we also have trading accounts where the spreads are relatively tight, where clients can buy and sell on the spot market physical gold, silver, platinum, and palladium.
Very cool, and people can learn more at kitco.com. That's spelled with a K at the beginning, kitco.com. So we're going to have to wrap up the interview. A little short on time today with our guests, but Peter, thank you so much for being with us on the program today, the Director of Global Trade with Kitco. So again, Peter, thank you so much for being with us today.
You're welcome, Jamie.
All right, and again, learn more at kitco.com. New episodes here each weekday morning, 9 a.m., thatbusinessnetwork.com. We'll be back in a moment.